So hold on just a second. Let me start recording. I'll share my screen with you again. I'll be also switching from McGraw-Hill Connect to my whiteboard because sometimes I might have to use my whiteboard for calculations. But again, this is the recorded lecture for chapter 1 and 2, review and practice problems. So like I mentioned earlier, a lot of students struggle either with how to debit and credit or how to interpret transactions before debiting and crediting certain accounts. So we will take our time today. We'll look at several different types of transactions. We'll analyze them like we did in chapter 1. Then we'll go ahead and journalize them. I'll show you how to do the journal entries. I will also show you how to do a few postings. And then we'll prepare a trial balance. In addition to that, I have included another problem. So problem 2 will help us prepare financial statements. So let's go ahead and get started. When you guys are working a problem like that on the homework or on the test, you need to remember that you will always act as the company's accountant. So it doesn't matter what Denzel Brooks' financial state is. What matters is what the financial state of Venture Consultants, which is his company, is. What matters is how those transactions affect Venture Consultants. So the first thing we're going to do is we will look at the transaction, I'll show you how to read it again, and then we'll analyze it and make the journal entry. We'll start with March 1st. Brooks, so he is the investor in his own company, invested $150,000 cash along with $22,000 in office equipment in the company in exchange for common stock. So again, you need to be thinking what happens from the perspective of the company. I'll go back to my whiteboard. So in this case, so this is the transaction that happened on March 1st. What happens in this case is that the company will get cash, $150. So cash is an asset account going up. It would go up $150,000. And then office equipment, which is another asset account going up, will increase $22,000. We're not talking about debits and credits. We're simply analyzing the transaction. So these are our increases. What the company gives up is common stock. So stockholders' equity will be increasing as well. So common stock will go up $172,000. So when I'm preparing the journal entry, I'll go back to McGraw-Hill and I will simply, so for this first transaction, I will increase cash. So this is a journal entry in proper format. It specifies the date. I always will start with the account that I debit. In this case, I'm debiting $150,000. Let's see, this is probably not going to work here for me. I'm using my Surface Pro, so let's see if I can do a 150. If I can do it that way. There you go. Okay, perfect. So I'm debiting cash. I'm also increasing not office supplies. I'm gonna try to find office equipment, and I'll debit that 22. $1,000. On the credit side, I know that common stock is going up as well. So I will credit common stock, but I'm not going to credit common stock for 150 or 22,000. I will credit common stock for $172,000 because that's the sum of the two. In addition to that, I'm required to enter, what am I required to do? Nothing else. So I think at this point in time, I'm ready to record my journal entry. So if I go back to journal entry 1, I can see the journal entry already prepared. So let's talk about what we just did. When the stockholders contribute cash to the company, cash is going up, but so is office equipment. The company is getting another asset account. One of the comments that I made, I said, I'm really looking for office equipment. Office supplies will not suffice here, is because office equipment is a long-term asset. So here is some lessons learned from that very first transaction. I have cash, which is a current asset. Not only it's an asset, it's a current asset because it's the most liquid asset. And in that same transaction, I had office equipment, which is a long-term asset. This we expect to turn into cash. Cash is already cash, so we don't have to turn it into cash, but we expect to use quickly. Office equipment we expect to use in the long term. And then I mentioned office supplies. Office supplies is another example of a current asset. We expect to use office supplies fairly quickly. Another thing that we need to mention is common stock. Common stock is a stockholder's equity account. We call this contributed capital. So all I'm trying to accomplish here with this exercise, I'll go ahead and share my screen again and go back to McGraw-Hill Connect. All I'm accomplishing here is I'm analyzing transactions, I'm journalizing those transactions, and then in the process, we're going over the different types of accounts and what that means. All right, so transaction number 2. It states the company prepaid $6,000 cash for 6 months rent for an office. When the company pays something, I'm going to go ahead and start with the account that I'm going to credit, because I know that when the company pays or prepays, we need to credit that asset account. So here's the $6,000 that we will, maybe if that worked, we will credit $6,000. Come on now. Hold on just a second. No, I thought I had this, working here. Okay, so here is the $6,000 in the account. For some reason, doesn't like it. Anyway, so cash is the account that goes down. The account that goes up, however, is the prepaid rent, not prepaid insurance. So if I scroll down a little bit, I should be able to find another prepaid account. So now let's see if it's going to let me debit and credit. So here's my $6,000 debited in this account. And $6,000 credited in this account. So let's see. It's very very picky today. Okay, there you go. 6 and another 6,000. I'm going to go ahead and copy and paste because just technology for you. Here's the 6,000. All right, there we go. All right, and then I'll record the entry here as well. So I'm going to go back to transaction 2, and I would like to talk about the prepaid rent account. So this is our segue into chapter 3 next week, when we have prepaid rent. So here is my whiteboard again. So we're on transaction 2. Prepaid rent is a prepaid expense. Prepaid expenses are current assets. So prepaid rent is a current asset account. I like to look at T accounts just so I know what's going on here. So prepaid rent is an asset account. All the increases will go on the debit side. All the decreases will go on the credit side. So in this case, the $6,000 that we just did on McGraw-Hill is an increase. The company prepaid rent for 6 months, which means if I take the $6,000 and divide that by 6 months, every month the company will be using $1,000 worth of rent. So this is something that you need to think about. This is something that we'll be doing over and over as part of chapter 3. Every month I need to credit the prepaid rent account. This becomes rent expense because the portion of prepaid rent has expired, and I should see $1,000 credited to that account how many times? What do you guys think? 6 times, right? 6 times. Very good, Dave. So 6 times. So Dave, let me ask you a question. So once we credit 6 times, what will be the balance in that account? 1, 2, 3, 4, 5, 6. At the end of the 6th month, there will be nothing left. Very nice. So $6,000 in credit, $6,000 in debit. The ending balance here will be 0. So I just wanted to start thinking about that as we move into chapter 3. All right, so I'm still working the problem. This is a longer problem. I'd like to continue analyzing some transactions with you. So if I look at the next transaction, we already did 1 and 2. Let's look at 3. The company made credit purchases of office equipment for $3,000 and office supplies for $1,200. So we already talked about the difference between office equipment and office supplies. One is a current asset. The other one is a current liability. I'm sorry. One is a current asset. The other one is a long-term asset. If the company makes a credit purchase, we know that this is accounts payable because the payment is due within 10 days. So can you guys help me out here? What am I debiting and crediting? And you can unmute yourself and tell me, walk me through. What's the first thing that I'm going to debit? I'm looking, scrolling down. I'm going to debit office equipment because it's an asset account. When I add to my asset account, I need to increase it on the left-hand side or on the debit side. And then I'll also debit office supplies. This is my current asset. I'm spending a little less on it. On the credit side, I'm going to look for accounts payable, which is right here. So let's try to type in the numbers here. Okay, so here we go. They bought $3,000. And then here they purchased $1,200 worth of office supplies. And then accounts payable, what now they have to pay within 10 days is $4,200. Okay, so I think I got a question from one of you, maybe. Let's see. 4,200 accounts payable. Very good, Lisa. That's exactly how it is. So let's review here what accounts payable are. Every time you guys see the word credit, the purchases credit, or the purchase was made on account, you should know that these are accounts payable. Accounts payable are current liabilities because the company has to pay their supplier back within 10 days. That by definition is a very short-term liability. So if you guys have any questions, please jump in and ask as we move through the transactions. I'm going to go to transaction 4. The company completed services for a client and immediately received $4,000 cash. So every time I see the word completed followed by services, these two words, completed services, I'm trying to figure out if this is revenue, and the word completed is in past tense. So if the services are provided or the services are completed and the goods are delivered or the goods are sold, this tells me that the company can recognize revenue. They received $4,000 in cash, so I'll debit the cash account, and then I will credit service revenue. So I'm looking for the revenue account. There it is. And here is what I'm going to input here, $4,000 for each one of them. Here's 4,000. And there you go. Any questions about this, Genchi? So is there a question? Every time we see the purchase of credit, and what else would mean accounts payable? Janelle, every time we see the word purchase on credit or purchase on account, so the company is buying something from a vendor and they're not paying cash, they're paying on account or on credit, that would be an accounts payable. Does that help? If you guys have any other questions, please ask. This is the best time to get clarification. Okay, perfect. So moving on, transaction number 5. The company completed, and I'm sorry, I tried to emphasize the past tense here. The company completed a 7,500 project for a client who must pay within 30 days. So again, if the company completed past tense services or delivered goods in the past, this means revenue. So I know that I have to credit revenue. So here's I'll find the service revenue account again. But let's see, what should I debit? So see how it says they completed the services for a client. The client must pay within 30 days. So Dave says account receivable and Eli says account receivable. And guess what? You guys are perfectly right. So I'll debit account receivable, $7,500. And then I will credit service revenue the same amount. And here, I think what you need to, this is the lesson learned in this section, is that when you're determining whether revenue has been earned and whether you can credit it, the method of payment is not important. Revenue is revenue when the services are performed and the goods are delivered, but it does not matter how the customer is paying. So look at transaction 4. They completed services for a client and immediately received cash. Well, here cash is debited. This is the method of payment. Service revenue is credited though because the services have been provided. And then look at number 5. In number 5, account receivable is the method of payment. The customer will pay within 30 days. So basically the customer has made a promise and no cash is collected at the time. All right, so let's look at number 6. The company paid $4,200 to settle the account payable created on March 3rd. If you remember, I'm going to scroll back here. On March 3rd, they promised to pay within 10 days. Now they're actually paying their supplier. So I'm back on transaction 6. The company paid. That means that I'll be crediting cash. when an obligation is satisfied, when an obligation is settled, that means the accounts payable will be debited because it's going down. So the $4,200 here will be debited to accounts payable, and we will also credit cash to show a reduction in the cash account of $4,200. So here is that journal entry. Do you guys have any questions so far? Again, this is simply practice for the first two chapters. Chapter 2, it's one of the most important, if not the most important chapter in this book. So I wanted to be very comfortable with it before we move on to chapter 3. Okay, so here we go. We are on transaction 7. The company paid $5,000 cash for the premium on a 12-month insurance policy. This again is a prepayment. I know that I have to credit the cash account for the amount, $5,000. And I know that because this is a prepayment, this will be classified as a prepaid expense or a current asset. I need to debit prepaid insurance, not rent, but insurance for the $5,000. So here is I'm going to ask you a similar question like I did a few minutes ago, because this is let me record the entry. So prepaid insurance in transaction 7 is $5,000. I always like to analyze. I'm going to go ahead and share my white board with you again. So I always like to analyze things in a T account. So here is my T account for prepaid insurance. This is an asset account, so debits mean plus, and on the credit side, I'll see minuses. In this case, we're debiting prepaid insurance $5,000. We're saying that this prepaid insurance is for a 12-month insurance policy. So if I take the $5,000 and divide it by 12 months, I will be able to solve for what will the company be using every month in insurance. So every month, 5,000 divided by 12 is about $417 a month. So every month the company will be using $417 worth of insurance, and for 12 months I'll be taking away until there is nothing more. Like Lisa said and Dave said earlier, once we consume, once we exhaust what's in the prepaid expense account, we are done and we're left with an ending balance of 0. All right, let's go back to McGraw-Hill. So here is the next journal entry number 8. The company received $3,500 cash as a partial payment for the work completed on March 9th. So in this case, we have a customer paying the company back. So in this case, I'm going to be collecting cash of $3,500. And then I'll be reducing account receivable because this is a partial payment. Account receivable will be going down by the same amount, $3,500. Do you have any questions so far? I'm recording this journal entry and moving on. So again, this is meant to solidify your knowledge of the material from chapter 2. This exercise set or problem set is posted on McGraw-Hill Connect. It's not graded. You're not going to find it on Blackboard. It doesn't affect your grade book in any way. So I strongly recommend that whenever you guys have a little bit of time to go through and try to make those journal entries on your own. All right, so here's the next transaction, transaction 9. or this is on March 9th, I guess. Yeah. The company completed work for another client. We already know that this is account receivable, debit 3820. And we know that we have to credit service revenue because the work has been performed. Same amount. In a minute, I will give you a couple of important accounting principles that deal with revenue and expense recognition. And you will know forever and ever, from now on, forever and ever, how to record revenue. So this is the revenue account that we just did. Okay, number 10. The company paid a cash dividend. The easiest account to deal with is cash. I know that I'll have to credit that $5,100. Dividends are paid directly to the stockholders. They reduce stockholders' equity. So when they go up, they have to be debited. So here's the debit to dividends of $5,100. So that was not a very complicated journal entry. Let's record it. And now we have the company purchased 600 of additional office supplies. So we know office supplies are going up. So we're debiting office supplies $600. And because the company has purchased the office supplies on credit, we will pick accounts payable as the method of payment of $600. All right, record the entry, and this is our last entry for the month of March. The company paid, again, that tells me that cash will be credited, $500. And then let's look at what they're paying for in cash. It's the month's utilities bills. So that would be utilities expense, $500. So I hope you found this beneficial. It's still so early in the semester that you guys are still learning the terminology. What we just did here is if you want to view the general journal, this is what the general journal looks like. Look at the March 2nd journal entry. Only 2 accounts are affected. So in accounting, every transaction would affect at a minimum 2 accounts. We call that, this one right here, this one right here, this one right here, where only 2 accounts are affected, we call that journal entry a simple journal entry. But look at the very first journal entry. It affects 3 accounts. Look at the one on March 3rd. It affects 3 accounts. Those journal entries are called compound. Let's see. How do you know when there will be 3 accounts affected? So Janelle, the transaction will tell you how many accounts are affected. So let's look at, I'll scroll up so I can show you the transaction. So on March 1st, the company receives cash. So here is 1 account. They also receive office equipment. Here is the 2nd account. And then the company gives common stock. So it will be in the description. It would be in the instructions that you guys are going to get when you're preparing those journal entries. But again, a simple journal entry will only have 2 accounts, like the one on March 2nd. A compound journal entry will have 3 or more accounts. Do you have any other questions? Anything else that we need to talk about? So I don't see any other questions in the chat box. So let's talk about posting. Oh, before we talk about posting, this is the general journal. We prepare the journal entries. So here's our journal entry worksheet. We prepare the journal entries in the general journal. So here is the general journal that we prepared. Please scroll to number 8. Lisa, this is, which one is number 8? This one? March 22nd? Yep. So we have cash and accounts receivable. Okay, no problem. All right, so do you guys have any other questions on the journal entries? So remember, the general journal is like a diary. It's like I mean, it literally is a journal. It shows every single thing that has happened to the company's financial statements in chronological order. So just like if you were, when you were younger, if you kept a diary or a journal, or I guess these days people keep blogs or vlogs. I mean, this is what that is. So the individual transactions are then posted into T accounts. So the second thing that we're going to do is we'll post the journal entries from part one to the ledger accounts. So those T accounts that I like using all the time, there's a lot of them. They are they're housed, so to speak, in the general ledger, and you can see how they are organized in the order of the basic accounting equation. You see the asset accounts first, and then right here, see that this is a liability account that's listed second, and then the common stock and the dividends or stockholders equity accounts, they're listed third, and then revenues and expenses are listed on the very bottom. So this is the part that I'm going to show you only a couple of the transactions. If you want to do this one on your own, you're absolutely welcome to do it. I'll post a couple of the transactions, and then I'll talk about a couple of important things when it comes to T accounts. So when you're posting, you'll go to the first requirement, right? You'll look at the journal entry. So the transaction on March 1st affects three different accounts. So we'll take that transaction on March 1st. We will debit cash because that's what the transaction on March 1st does. It increases cash by $150,000. So we are reporting the effect of the transaction that happened on March 1st in the individual accounts. So the thing that I love about McGraw-Hill is that it automatically calculates a running balance. So remember, the first transaction affects not just one, but three accounts. So I increased cash. I also have to increase office equipment. So this is the transaction on March 1st. And if I remember correctly, office equipment needs to be debited $22,000. So where is my office equipment? Yes. And there's a third account affected. That would be common stock. So common stock, the date is still March 1st. Common stock will be credited, though, not debited, because it's a stockholders equity account. So common stock will be credited for 172. All right. Did we do this correctly? Nope. It didn't take my credit. It's my credit now. 172. There you go. All right. Now I want to, this is the transaction that I wanted to post. I have effectively finished posting. I'm going to do, let's do one more just so I have a few more numbers here. I'll go to the next transaction, March 2nd, prepaid rent in cash. So I know here that my cash will be going down $6,000. And see how now the ending balance is adjusted to show the decrease. And I also know that the $6,000 was to prepay for, was it prepaid rent or what was the transaction? Let's go see. Prepaid rent and cash. Okay, so I think I'm in the right account. So the $6,000 will be debited here. Okay, so here we go. This is what I wanted to talk to you about. All right, the T accounts. The T accounts, depending on the type of account, will increase either on the debit or the credit side. So here is what you should remember, and you know, this is knowledge that you guys are going to need for the rest of the semester. The T accounts have a normal balance, right? The normal balance of those T accounts is always on the increase side. So in this case, the T account has a left-hand side and a right-hand side. We always have to show where the transaction came from. This T account happens to run to have a running balance. When all is said and done, we hope the normal balance to be on the debit side, because cash is an asset account. It increases on the debit side. And you know, that's what we would like to have, right? We want cash inflows to be higher than cash outflows. So for asset accounts, their normal balance will be on the debit side. I'm going to scroll down and look at the common stock. For common stock, stockholders' equity accounts, liability accounts, revenues, they will increase on the credit side. So we expect their balances to be on the credit side. So you guys are going to, if you want to finish this exercise, you'll continue taking each one of the transactions and posting it to the different accounts. This is what we call posting. We post in the general ledger. The last step in the third requirement, we will prepare a trial balance. And the way a trial balance is prepared is by taking all the accounts and showing the debit or credit balance in those accounts. That's the reason why I wanted to. Jacob, do you still have a question? I'm sorry, I didn't see that you raised your hand.
Yeah, it was about common stock.
Uh-huh.
Uh,
What about it?
what else increases common stock besides the initial investment, like purchase of
Um,
land or
no,
more
just
equipment?
so it think about let's talk about a publicly traded corporation. So far, I mean, in this problem too, we have dealt with like a sole proprietorships or partnerships. Um, so the owner contributes to the company. But if you think about a publicly traded corporation, um, every time a company has an initial public offering or IPO, stock issuance will result in higher common stock. So the company can have an IPO, which is the initial, or they can have subsequent stock issuances and add to their common stock. But common stock is only increased by stock issuances. Does that make sense?
Yes, ma'am.
Okay, good. Great. Okay, so let me show you. So I'm going to get out of here because this is the student view. Let me show you what the solved problem looks like. Uh, we did all the journal entries like we were supposed to, but I wanted to show you the T accounts. So once the T account balances are calculated, so look at the cash account. We show all the increases on the debit side. We show all the decreases on the credit side. We have this running balance, which is a positive balance. This is a debit balance. When we prepare the trial balance, we would simply list the account title and show whether that account has a debit or a credit balance. So the whole point in preparing a trial balance is to show the equality of debits and credits. At the end of the day, we want all of our debits to equal all of our credits. So in this case, we know that we did a good job because debits equal credits. The trial balance is actually a very useful tool. I spent 15 years in corporate accounting, and we would always pull a trial balance at the end of the month to make sure that our accountants did their work correctly. So at the end of the day, if we found a little discrepancy in the trial balance, we had to go and research that. Okay, so I'm sorry. I think you guys were just looking at our my Blackboard. So here's what I was showing you, or trying to show you. So hold on. This is what I was trying to show you. So here's the cash account, all the ins on the debit side, all the outs on the credit side. We're ending with a positive balance, and look at this number, 136.7. Here's the number on the trial balance. All we're doing is listing all the accounts and showing whether or not they have a debit or a credit balance. So before we move on, before we look at the next problem, I want to summarize. So credits and debits, yeah, credits and debits should always be equal. So here's what I wanted to summarize here on the whiteboard. Asset accounts will have a normal balance on the debit side. So this is the normal balance because debit means plus. Liabilities and stockholders' equity, their normal balance will be on the credit side because for them, credit means a plus. And now there's three other different accounts that are not included in assets, liabilities, and stockholders' equity. We have revenues, expenses, and dividends. So for revenues, the normal balance will be on the credit side. That's the normal. For expenses and dividends, the normal balance will be on the debit side because that's their increase side. All right, so let's see. Do we have questions? No questions. Okay, here we go. So let's go back to McGraw-Hill, and I'll make sure I'm sharing my application screen here with you. So here is McGraw-Hill Connect. The second problem, and I'll go back to the student view because again, this is chapter 2, chapter 1 and 2 practice problems that go with today's lecture. I'll look at the student assignment view because, like I said, that's how you guys are going to see this if you choose to practice it. So the next question, and we have about 13 minutes left, so let's see if we can get as far as I had hoped. So here's the next question. Actually, yeah, we can do this in 13 minutes. Because chapters 1 and 2 have taught us a lot about accounts and balances, we shouldn't have an issue preparing the financial statements of a company. So financial statements of a company is something that you guys need to be super comfortable with. Every company would prepare their income statement first. The reason for that is the company will need to decide what to do with their profit, and then they'll need to incorporate the profit into the retained earnings. So the income statement is prepared first. What goes on the income statement is revenues. Some companies would have multiple sources of revenue, just like the one that we're going to look at in a minute, and expenses. So we'll prepare the single step income statement, and then we'll use the net income or the profit to add it to the statement of retained earnings and eventually the balance sheet. So it's important for you to know what accounts go where. So here I'm looking for consulting revenue, anything that is earned revenue, I'm going to place on the income statement. So I found consulting revenue, $12,000. I'm also looking at rental revenue, $500. So on the income statement, we report performance for the month ended. So the income statement reports performance for a period of time. In this case, for the month ended March 31st. The first thing that I'm going to show are revenues. I'm going to start with the largest revenue, which in this case is consulting. Let's start typing and maybe I'll find it. Let's see, consulting revenue. I'm going to follow that with the smaller source of revenue, which in this case is rental revenue. Let's type this rental. So rental revenue, let's see if it popped up. There is the rental revenue. Then I'm going to total all revenues. And I'm going to do it where? Here. I'm looking for just revenues. Okay. Come on, revenues. I'm going to scroll down a little slower here. Don't miss it this time. Where is the total revenue? Let's see. It's not pulling up total revenue, but I do need a sum of both of my revenues. I need something here to show me what the total revenues are. So here is the $12,000. And here is, oh, there you go. It popped up by itself. I should have thought about that, but I didn't. That's what happens when you work problems real time. Anyway, and then we have rental revenue, 500. All right, here we go. Now the income statement is happy and looking okay. After that, we'll take expenses and we'll list every single expense account. Starting with salaries expense. After salaries expense, I will show rent expense. After rent expense, I'll show advertising expense. After that, I'm going to show utilities expense. Utilities expense. I think those are all the expenses that the company incurred. Where is utilities? There it is. Okay, so we have $3,000 here. For salaries expense. One of the things that you'll notice, the expenses are also organized in the order of size. I'm starting with the largest one and I'm going to the smallest one. So here is my advertising expense, which in this case is $400. And then utilities expense is $200. We call this income statement a single step income statement because all we have to do is take all the revenues of $12,500 and all the expenses of 56 and calculate net income. Take the difference between the two, which in this case, the company has realized a positive net income or profit of $6,900. All right, so 6,900. Let's see if this is correct. Yep, okay. So again, when you're preparing financial statements, the first one to make is the income statement, because we need net income. We need to decide what to do with this profit. The company is profitable. There's really only two things to do. One is to pay dividends to the stockholders. The other one is to keep net income. So in this case, if I scroll up, I can see that the company has decided to pay dividends of $2,000. So I'll go to the next statement. I have a question here. Let's see what the question is. So we have to put the expenses in order. Yes, the expenses have to be just like I did. See how I listed them largest to smallest? The only exception would be income tax expense. If we had income tax expense, that would come last regardless of how big or small it is. Okay, so the company prepares the statement of retained earnings. What about telephone and miscellaneous? It depends on how big they are, Janelle. Do we have telephone and miscellaneous? I'm just going with the information up here. So if we have any other expenses, we will fit them in depending on how big they are. All right, so statement of retained earnings is for the month ended March 31st. It would have a beginning balance on March 1st. There is nothing in this case. If I look at the table up here, there is no retained earnings March 1st. To that, I'll add net income. And net income here is the $6,900 that we just calculated. Then I will subtract dividends. Dividends, I saw up there in the table, dividends are $2,000. And I will be able to calculate retained earnings at the end of March to be $4,900. That's how the income statement is related to the statement of retained earnings. I need these retained earnings to plug them in here in the balance sheet, so you guys can finish the balance sheet on your own. But remember, retained earnings, $4,900, will be plugged in into the stockholders' equity, which would be right down here. So I hope you found this helpful. On Monday, there's no homework due this coming Sunday. I would practice these problems if I were you. I would also practice, if you go back to the Chapter 2 folder, and if you haven't worked on the in-class practice, do that. And we will resume next week with Chapter 3. Do you guys have any questions?